Hey there, everyone. Today on the Final Bar, the major equity averages slightly higher today, with the S&P closing back above the 4,300 level. Energy stocks leading the way higher today, with defensive sectors like consumer staples continuing to lag behind our benchmarks. Today we'll open the Final Bar Mailbag. What industries perform well in a stagflationary environment? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. In general, on the StockCharts platform, we tend to focus on medium to long-term time frames, but we have all the data and all the information to help you understand what's happening in the short term. And that is what I hope you take away from our show every weekday after the close is what happened today, how that relates to the big picture. I have found, particularly if you are more of a medium-term, long-term investor, it is very easy to get caught up in what we call the flickering ticks, the short-term market fluctuations, in a lot of cases which are just noise for you. But a lot of times you get drawn in and all of a sudden you make long-term decisions based on short-term data. I always tell people to make short-term decisions using short-term data, make long-term decisions using longer-term data. So we'll think about what happened today, think how that relates to what we learned last week with a lot of distribution after the Fed meeting on Wednesday. We'll talk about what may be coming up here soon as the S&P begins to test some key support levels. Let's get to our market recap and look at how the charts evolved here on a rainy Monday in the Pacific Northwest. Before we get there, we asked you a question recently on our social media accounts and on our YouTube channel. Does gold make a new all-time high? That would take it over $2,100 an ounce. Do we get a new all-time high before year-end 2023? Yes or no? 57% of you said no, we are not going to make a new all-time high. And what's funny is that's not too far above current levels, to be honest with you. 43% then saying, yes, we are going to get up there. Let's look at the chart of gold actually and see where we're at. Then we'll continue our market recap from there. So two common ways you can look at gold on our platform. The one is basically spot gold, and it's taking it from the futures market. That's $GOLD. That's using what we call a continuous contract. And then GLD is another good thing to look at. And that's good for intraday analysis. That's an ETF. So as a trading vehicle for a lot of individual investors, certainly for financial advisors, the GLD is often a decent opportunity. When you look at the chart of gold, what's interesting to me is we're currently around 1950 or so, maybe a little bit below there, testing the 200-day moving average. All-time highs are up here around 2080 to 2100. That's not too far above current levels, right? So there's a time when gold was way below all-time highs, and I wouldn't even have asked this question. But we recently tested it, right? And in May, not too long ago, less than 6 months ago, we are testing the high from March of 2022. Now we've pulled back, tested Fibonacci support, which is just above 1900, and now we're sort of in this sideways pattern. I would argue we are trapped between two technical levels. The one is a trend line using the high from May, the high from July, the high from August, and so on. We actually just tested that again last week. On the downside, we have the 200-day moving average, and not too far below that, again, that same Fibonacci level, I think pretty important. My call on this, or my take on this would be one of these things is going to break pretty soon here, arguably as soon as this week. We either break above trendline resistance, in which case I would say a move to all-time highs, certainly a possibility and something to think through as a potential outcome. We break the 200-day, and all of a sudden that puts a little more downside pressure on gold. 1900, of course, a pretty significant support level that has been tested and confirmed a number of times. I probably would not say gold's going to make a new all-time high, but only because there's a limited amount of time left, and gold would really have to change its character. For now, I'm not seeing enough on the chart to sort of think that that's a reasonable outcome at this point. What's great about technical analysis, though, is the chart will tell you when that is something to think about when we break above resistance. Keep an eye on this chart, certainly this week, to see if and when that happens. Let's continue on with our market recap here. As I mentioned, the S&P, the NASDAQ up slightly higher, about 0.4 to 0.5%. Kind of a choppy session more than anything. This was sort of a lick your wounds day after Thursday and Friday. So literally last week, Monday, Tuesday, Wednesday till 2:30 Eastern was a very low volume, kind of quiet, sit on your hands holding pattern type of period. The moment Chair Powell started talking around 2:30 p.m. Eastern on Wednesday, the market started deteriorating and then just continued. By the end of the week, a lot of breadth conditions went from kind of bad to pretty bad. a lot of support levels that were sort of in place now being either broken or tested for sure coming into this week. And overall, I would say the market's sort of on its back heels, sort of leaning back a little bit after the distribution that we saw on Friday. Today, a bit of a bounce to the upside, totally fair. The S&P bouncing off of that, just about 4,300, finishing the day around 4,337. The Nasdaq Composite up about 0.5%, not too much, just above 13,270. Mid caps and small caps all up about the same. I wouldn't say there was a ton of differentiation, although the mid cap S&P 400 index had the best performance of that group. And the VIX actually came off slightly, so back below 17. But when I look at the chart of the VIX, which we'll try to get to in a minute, very interesting to see where we're at in the VIX as of last Friday and where we were at the August pullback, right? So you have that July peak, we had the pullback into August, the rally into Labor Day, and now we're in sort of this third wave down. We're kind of at a similar level in terms of some breadth conditions, in terms of volatility, very, very similar. So are we setting up for another one of those bounces to the upside? I think that certainly is the question we'll be focused on through the course of this week. Interest rates moving higher. I was at a conference, and a shout out to the guys at FX Evolution, had a great conference in Las Vegas over the weekend. A number of fellow CMTs were presenters, which is always a pleasure to get some different takes on the technical inputs that we're all evaluating in different ways using different sets of charts. A common discussion was the interest rate environment, stocks versus bonds, and any of the speakers that were more long-term oriented just focused on the relative proposition of owning stocks versus owning bonds. That ratio continues to favor stocks, even during pullback phases in the last couple of years. Now, rates going higher mean bond prices are going lower, and that's what's continuing to fuel that trend, which persists through last week and certainly today as well. 10-year yield pushing higher to 4.54, the long bond yield around 4.66. So we continue to see higher movements in interest rates. Again, when I take a step back and just think about what that means, that usually is a big time headwind for growth stocks. And when I see a day like today, when it's not growth at the top of the list and interest rates are going up, it all kind of makes sense. And I would say that is why. The dollar index moving up by about 0.4% using the UUP ETF. Commodities mostly in the red today. Natural gas ETF was up a little bit, but overall, most things in the red. Notably, silver prices down about 1.8%. One of the charts that Rashmi, who writes the CMT newsletter, Rashmi Bhatnagar, she had talked about the silver to gold ratio, which I thought was a really interesting relationship to pay attention to. And silver versus gold is kind of a risk-on versus risk-off general movement in the commodity space. So today, silver underperforming gold, and we see that. That's a sort of a an asterisk to put on, or put a pin in that particular chart and see if that persists. Both gold and silver lower today, and the GLD was down about half a percent. Finally, cryptocurrencies all in the green. I exchanged messages with Adrian Zadunchik, who's been on our show a number of times, talking with him about work that he and Jeff Hirsch had been talking about, which is looking at seasonality in cryptocurrencies. Still pretty early days in cryptocurrencies, right? When you look at stocks, you have decades, if not centuries, of data to crunch, to look for trends and look for seasonal patterns. And I think in modern, U.S. history, post World War II, kind of 1950 on, is a pretty good group of cycles to pay attention to in sort of the modern era of the financial markets. But with cryptocurrencies, obviously a lot less data, right? Just because it's a newer market. But if you start to look at the trends, the fourth quarter actually tends to be pretty strong for cryptos. And so, are we setting up for another seasonal run into year end? That has not always been the case, and there have been years where the fourth quarter has not been particularly strong for Bitcoin and Ether. But the trends, or the longer term sort of average cycles, would be favoring that. Bitcoin finishing the day just below 26,400. Obviously, these trade all the time, but as of our live broadcast here after the U.S. equity close, and Ether just below 1,600. In terms of sectors, again, when I think about rising rates, if you told me rates were going up and the market's sort of hanging in there, not really in a severe downtrend, what things are probably leading? I would probably say energy and materials would be my first two guesses. Because energy tends to do well on higher commodity prices, and so do materials in general. And that's kind of what we saw today. The XLE up 1.2%, material sector, XLB up 0.8%. We've not seen materials at the top of the list very often on a relative basis. It's not been particularly strong relative to others. And then the XLY was number 3, up 0.6%. At the bottom of the list, it's all the defense. So consumer staples, REITs, utilities all down, and not by much, right? The worst was consumer staples down about 1/3%. So if you think of sectors kind of generally speaking in three buckets, and this is not a perfect way to categorize them, but that's sort of the back of the envelope way that I think about this. You have growthy offense like the FANG sectors, technology, consumer discretionary, communication services. You have cyclical leadership, more value-oriented stocks like energy, materials, industrials. Then you have pure defensive plays like utilities, consumer staples, and REITs. We have not seen a risk-off move where things like utilities and real estate are outperforming, although in the last couple of weeks, utilities is one of the top performing sectors just behind energy, and energy has been number one, I think, so far. Pretty sure that's true month to date with today's move, certainly solidifying that. So it's more of a rotation away from growthy offense to value stocks and not to pure defense for now. But I would be very closely monitoring things like consumer staples to see if they begin to outperform. Not happening on a broader basis just yet. Let's spend a little bit of time looking at the S&P 500 here. I was writing a note for my market misbehavior premium members yesterday from the airport, actually, before I boarded a flight back to Seattle. I was writing some notes just about different ways to measure the S&P, think about what we've learned. You know, I'm inclined to label this a head and shoulders top that's confirmed. And I posted a video on my YouTube channel called Market Misbehavior on Friday, sort of explaining the head and shoulders top, what the measurement technique would look like. So if you want more information on that, I would check out that video where we sort of laid out the different measuring techniques. But we've clearly broke the neckline, and today we rallied right back up to the neckline, which is why I think this is still very important to watch. That's why it's a big, bold red line on my chart. We've now broken down on Thursday. We confirmed it with a lower close on Friday. Now we're testing that as a potential resistance level from below. So my main question for this week, do we hold below that neckline? Do we break this trend line using the major lows of the last 8 or 9 months? I think those are the key things to watch. 4,300, of course, was today's low, right about there. That's an important level we've been talking about. That's the August high from last year. So we're right at a pretty key support level. Now, there are a couple different ways you can actually measure a head and shoulders and define where we're at right now. What's funny is I was actually looking on some of my old chart lists for the chart I'm about to show you at the head and shoulders top, and I came across this other one, which was a chart I shared probably on this show called S&P Head and Shoulders 2022. And I remember as this was playing out and as we had distribution, this is after 2021 was just a banger of a year going straight up, higher highs, higher lows, limited drawdowns, to 2022, which felt like the market turned on a dime and started to go lower. We had that initial drop around 12% and then rallied higher. And what I did was sort of create, talk about this as a head and shoulders. Now, this was not a kind of classic head and shoulders pattern in that the neckline was sloping downwards. Usually a neckline is flat to slightly sloping higher. That's kind of the ideal head and shoulders pattern. But what I did was basically say, if you just consider this a flat level from the left, the midpoint below the left shoulder here, and just take that, that's about a 10% range from the peak to the neckline. You project that from the downside, that gave you a downside target around 3850. Really the more correct way to measure a head and shoulders, which I showed here in purple, is to take the lows, and that gives you about a 12% range. You project that from the breakdown, and that gives you a downside objective around 3625. Not far off from where it actually played out. So when we talk about head and shoulders patterns, when we talk about objectives, and it seems crazy that you have a downside objective to a certain level, the reason why we keep using them is because they've worked in previous cycles. So look back at some of the previous major tops, you will find patterns like this that tend to come up. So what does the measurement technique look like here today? As I mentioned in the video, you'll get a little more details, but about a 6% range from the top of the head to the neckline. If you project that from the breakdown level, gives you an objective around 4050 to 4100. And for now, that's sort of the base case that I think makes sense here. Now, an alternate hypothesis, maybe a different version that could play out. We talked about a month ago when we had that initial sell-off in early August about an ABC corrective pattern. It's a classic, basically an Elliott wave pattern, where after you have a big run, you have a 3-wave corrective pattern. And this is known for wave A and wave C to be very, very similar in terms of the shape, the direction, the price distance, and the velocity of the trend, basically. If you would consider this to be wave A from late July to mid-August, and this to be wave C after a little wave B bounce at the end of second half of August, that gives you an objective around 4260, we'll call it. and it would end right about now. So the fact that we've kind of gotten down to this level, which also lines up with trendline support, tells me the alternate hypothesis for now tells us we're kind of at that point where you'd expect a bounce here. So a bounce this week, I would say, may validate this ABC corrective call and would suggest further upside from here. That's, again, I think we're at a critical point for support. And if we break below that trend line, for me, that would say this is not the right theory. We need to go back to the head and shoulders top, think about downside measurements, and really focus on capital preservation and measuring potential downside. Just to finish off here, a couple of random stocks to share with you. Ross Stores is a name that we've talked about before, pulling back to a 200-day moving average. What's interesting about a chart like Ross Stores is, back here, it looked fantastic. And I remember looking at Ross Stores as a potential cup and handle pattern. It was kind of a cup without handle. And I was thinking, all right, do we have a little pullback? And then, this is what a handle would look like, which would make this classic cup and handle pattern, and a breakout above like 123 would complete it. That is not what we've got, and that's why you need to wait. When you see a stock testing resistance, you have to wait for that breakout, for that follow-through, like we've talked about previously. We didn't get it. In this case, you saw things rotate lower, and it's really accelerated second half of last week, and now again today with a gap lower, now below the 200-day moving average. Now, the last time we tested the 200-day was back in May and June, traded below it randomly here for about a month before recovering and going back higher. And again, I'm super happy being patient and waiting for this sort of move, which is a sign that we're breaking out of this resistance level. For now, this is a stock just going down. We're oversold, but that just tells me we've gone down a lot. I would be looking for a bounce here, but I'm not seeing anything on the chart yet telling me that bounce is imminent at the moment. Southwest is another one, and I'll share with you two stocks, Southwest and Conagra Foods, one airline and one food company in consumer staples. These are basically why I don't buy new lows, right? When you see a stock testing support, I often get asked, is this the time to buy? And my answer is, I am super happy to wait for the chart to look better. I don't like buying things that are going down. This is more of the falling knife approach. I would much rather find an opportunity where there is a sign of accumulation, a sign that buyers are actually coming in and pushing the price back higher. You're actually not seeing that. You're seeing a gap lower today, suggesting maybe further downside. Conagra Brands, same thing. This is in food products, which has been a pretty tough group within a tough sector, right? Consumer staples not doing well. Food products, some of the worst charts you can probably find in the sector. And charts like this just keep going down. So again, when I find a stock that is down a lot is not a great investment thesis in my experience, right? Testing support, maybe, but I would much rather wait for a sign of accumulation, a sign of a change of character, a sign that this downtrend is no longer happening, but that you're starting to see buyers coming in. Days like this on both of those charts tell me today is not that day. That's it for our market recap. Checking in on some of the key charts that were on the move today, some of the individual names as well. We're going to get to the Final Bar Mailbag here in a moment. A couple quick announcements before we do it. First off, we welcome your questions. The mailbag is all filled with questions that came from people like you in the last couple days. We appreciate so much the questions that you're sharing with us. Please keep them coming. The mailbag can always use one more question. Our email, that's the best way to send it to us, thefinalbar@stockcharts.com. On X, just tag us at FinalBarSCTV, and on our YouTube channel, just put a comment below the video that you're watching. We'll gather all of those and hope to answer yours in our next mailbag segment, I think Friday of this week. Also, as a reminder, we have a live Q&A every Wednesday at 1 p.m. Eastern. You can tune in here on our YouTube channel for that live event. Again, it's all driven by your questions. I'll have a chart or two queued up just to get things going, and then we'll start at the top and go through the chat. So get in there early. We have the super chat feature set up, so if you want to make sure your question gets answered, you can pop it right to the top of the list. If you go to our live tab on our YouTube channel, you can set a reminder so you don't miss it. But we'll look forward to seeing you next Wednesday, or this coming Wednesday, 1 p.m. Eastern, 10 a.m. Pacific, here for a live Q&A on our YouTube channel. Let's get to the Final Bar Mailbag. And again, thanks for all the great questions. Let's get to question number 1. Dave, how do you handle position sizing? Divide into equal parts or based on stop losses? Very interesting question. And what's funny is the conference I just mentioned, the FX Evolution Conference, and again, a shout out to the guys there, Tyrone and Tom and others that do a really, really good job. A lot of really good analysis of short-term price dynamics. We had some great conversations about different timeframes, but a big focus from on the conference there was about technical analysis for risk management. I mentioned that in my presentation. I know a number of other people did as well, because I find a lot of newer technical analysts or newer traders that use charts think of technical analysis as the way to find the next home run, right? How do you find the next buy idea that's going to work? And I'm not saying it's not great for that, but I have found technical analysis is infinitely more valuable to your portfolio in risk management. It tells you when something's not working, and it tells you when to unwind a poorly performing position. I think that is one of the most important things you can do, is have a good money management process. The reason why I mentioned that is in your question, you said you base it on stop losses, and I'm not sure exactly how you would do that, but I would certainly not think of it that way. You need to think about, in my opinion, you need to think about position sizing and risk management as two different things, but two very important things, right? Risk management is how do you manage stops? How do you unwind a position that's not working? How do you stay in a position that is working? That is a very important part of trading, and something I think people don't spend nearly enough trying to improve on. And I would encourage you to think about that. When you think about position sizing, general takeaways. If you're having trouble sleeping at night because of a position, your position size is too big. Now, that's more of a behavioral comment, but it's absolutely true. If you find when you're not thinking about the markets, but you're thinking about some position and you're nervous about the exposure, then you need to bring things down. General, if you talk to experts, general comments that I would hear would be something like a 2% is a good sort of general exposure, right? More than that is often a little more than you may want to make on average. But again, if you have very concentrated positions, you may have a bigger position. I think being thoughtful about what allocation you have to different ideas is important. One of the things we've talked about before is sizing your bets based on volatility. And I would encourage you to think a little bit more along those lines. What I tend to do in my own trading is think about an average position. So I don't like to do more than like 2 to 5% on a particular idea. I very rarely would go above 5%. For any reason, besides like a core position like an S&P or something, which is just kind of the bulk of a portfolio. The smaller positions, 2% is probably the most that I would do. But you want to think about it a little in terms of volatility, because if you had 10 stocks in your portfolio and you had 10% in each stock, and 9 of them were utilities and they moved very little, and then one of them was a small cap biotech name, your portfolio is going to be driven almost 100% by that one stock, because the other ones just won't move enough to move the needle, right? The one volatile stock is going to cause all of your portfolio to go up or down, because that's the one where the movement's going to be. So in general, having a bigger size in a smaller volatility name and a smaller position in a larger volatility name kind of evens things out a little bit. So I would encourage you to look at risk sizing or volatility sizing your positions. It's kind of a more advanced way to think about your positioning, and I think that could be helpful. But definitely, I would think of having an upside limit. 2% is a good starting point for a lot of investors, and then go from there. Just be thoughtful about what percent you're allocating to each idea. Great question, by the way. Question number 2, what industries I love this one. What industries do well in a stagflationary period, and why? So I will start off by telling you that stagflation, and whether we are in a stagflationary or inflationary or deflationary environment or disinflationary environment, these are adjectives that economists argue about endlessly, and we'll never really know the answer to. So keep in mind, it is very much an art to figure out what kind of period, and those labels are more about, I think, the sentiment around that period than it is about the actual data. But stagflation is a concept that combines stagnation, meaning economic slowdown, with inflation, meaning prices are very high. So the 3 things you look for are low economic growth or a slowing economy, high inflation, meaning prices are pretty elevated, and high unemployment. So one thing we're not necessarily seeing right now is high unemployment. Unemployment numbers are actually pretty reasonable. We are still seeing inflation, even though it's come down. It's a little more elevated, and the economy certainly appears to be slowing down, although that is also hotly debated in economic circles as well, whether or not it is slowing down the right way or the appropriate way. The 1970s are a great stagflationary period, probably the classic one. If you think about what marked that period, oil prices, right? Oil prices being so high, and that is often one of the markers that people will look for. So when you think about whether we're in the stagflationary period, one of the things I would look at are crude oil prices. And, pretty hard to deny that oil prices are going up. When we talk about the energy sector doing so well, big driver of that is because energy prices are so high, right? If crude oil is trading at a much higher level, that just tends to be pretty good tailwind for any company involving in pulling oil out of somewhere or selling it to someone else. It's just a better environment for them. So things that make sense would be higher oil prices, which means sectors and groups that tend to do well. Energy stocks would come to mind. So the fact that we see higher oil prices, stronger XLE, the energy sector doing quite well recently, certainly plays pretty well. That tracks pretty well. Materials sector and any commodity related things, gold tends to do better. Within commodities like agriculture, so I'm thinking of my conversation with Ms. Schneider. She often brings up the DBA, which is an agriculture ETF. We talk about the DBC, which is a broader commodity ETF that has a big energy component. DBA is more the agriculture part of the commodity space. So ag stocks and ag ETFs tend to do better. And then real estate actually tends to do pretty well in a stagflationary period as well. So the real question, I mean, the real problem is, debating that label. And what's funny is people debate that label, and it's hard to get data to confirm whether it is a stagflationary period until way down the road. We'll look back and be able to label it a lot more easily. It's hard to track during the period, but higher oil prices, a big marker. The economy slowing down, so economic data getting weaker would map to that pretty well also. Thanks for that question, by the way. Really made me think and dig into the 70s, which I hadn't done in a little bit, so thanks for that. Next question. Thoughts on LLY, Eli Lilly. Is that a buy the dip candidate? Really good question. Thanks for asking about a specific name. This question, by the way, came during our live Q&A last Wednesday. So again, as I mentioned, if we don't get to the questions in our live Q&A, we can always throw them in the mailbag and get to them when we are able. So Eli Lilly is one of those charts. It reminds me a lot of like an Alphabet, a bit different, but in a similar kind of phase. A lot of stocks like a Warner Brothers Discovery in a clear downtrend, right? Paramount. These are communication services names, making new lows. Clear distribution phase, not in question, I think, at this point. Just kind of going down and to the left. Then you have names like Alphabet, like Eli Lilly. They're in a clear uptrend, right? And how would we define that? Higher highs and higher lows. And Ralph Acampora, when he was here a couple weeks ago, and again, we had some really cool interviews with Ralph, so make sure you check out. He was on our show a couple weeks ago. It was fantastic. Just great. He's a fountain of market history and certainly technical analysis wisdom. One of the things he reminded us as practitioners is in an uptrend, you're going to make new highs. That's just what defines an uptrend. But the really key points to look at are the lows, right? Making sure when you pull back, we keep making a higher low, and get wary when we come back, we pull back, and we don't make a higher low. We actually make a lower low. That's what often tells you that the uptrend may be slowing down. So I would say for now, Eli Lilly in pretty good shape. And one of the basic things I would look at is an ascending 50-day moving average. When conditions are strong, when a chart is in a bullish phase, on average, the 50-day or the 10-week moving average is just kind of a basic starting point. As long as we hold above an ascending 50-day moving average, the trend is pretty good. We start to break that, I think you need to put it in question. Eli Lilly gapped higher. It's now trading higher. For now, still making a higher low. I think as long as we hold the 50-day, this seems like a constructive chart. I would say the same thing for like an Alphabet. I think it's in the same sort of phase, pulling back to an ascending 50-day moving average, holding above previous support. We'll call it around 126, 126.50 or so. So with both of these charts, I'm inclined to assume that that trend will continue until proven otherwise. I would absolutely have a good stop in mind if you would pull the trigger on a name like this, because the chart will tell you if that buy on the dip did not work, right? If this wasn't a dip at the beginning of more of a decline, your stop will be triggered, you minimize your pain, you get out, and if it works, you're in at a pretty good place. So I think both of these charts are still constructive unless and until we break below the 50-day moving average and follow through. Both of these holding for now. That's why I think Eli Lilly for now still a pretty decent chart. Next question. With a head and shoulders pattern, do you use percentage drops to arrive at the downside target or absolute price change? Yeah, I mentioned the video that I put on my YouTube channel called Market Misbehavior. I would encourage you to check that out. I posted it on Friday and talked about this particular concept of what to use. Now, what you have to remember is Edwards and McGee, who wrote kind of the book on price patterns, is back in the 1950s, 1960s, I want to say, is when it was published originally. But Ralph Edwards and John McGee, famous market practitioners of the time, some of the best known experts, and really wrote the book, Technical Analysis of Stock Trends. Still a fantastic read to just reinforce the basic premises that we use as technical analysts. In their day, log scale charts were not particularly common, and arithmetic charts were more common because you did all your charting by hand, and it was much easier to do it arithmetically because you could just draw the line than a log scale. Now, some people did that, and we actually at the Fidelity Chart Room had the old log scale paper, that a paper company that would sell them log scale paper that engineers would use, and they would use it to chart log scale prices. But you had to do a lot of calculations to do it right. Most people couldn't go through that sort of headache. And so, regular arithmetic scale charts were much more common. Now, I think if they could have used log scale charts, they would have, because it's a much better representation. So I tend to measure the height of the pattern using percentages. So I would say a 6% drop from the head to the neckline. That projects down to this point. But you can do it the arithmetic version as well. It actually isn't too different in this particular example. You say 4,600 to 4,350 is about a 250 point swing. So you subtract 250 points from the neckline, that gets you down to 4,100. So that would be right there. So arithmetic scale says 4,100. Log scale says 4070. That's not too different for me to think, which one do I use? I would say in general, they're both kind of pointing down to this particular range. So pretty similar. I would argue log scale is the way to go. Others of my peers will argue the other side of that. I think they're wrong, but that's okay. We all can have different approaches, and I think it's usually more what time frame. If you're looking at shorter term time frames, arithmetic scales are totally fine. But I look a little more longer term. Log scales are absolutely important. That's why I think it's a good way to do it. Final question for the day: how valid is the inverted yield curve in light of the post-COVID black swan environment? This is such a cool mailbag. Some non-technical questions that were really fun for me to sort of think about and prepare for. So thanks, guys, for sort of going outside of the technical arena. I appreciate it very much. So the inverted yield curve, as a reminder, when we talk about our market recap and we talk about where things are at, on your dashboard, if you're a StockCharts member and you go to the bonds tab, this basically shows you the inverted yield curve. Now, it goes from long end to short end. So the short end of the curve is around 5.3%. The long end, the 30-year point, is call it 4.7%. And so that's why there's this inverted yield curve. The short end is higher than the longer end. We have a great visualization tool. If you click on Charts and Tools, it's actually a free tool it's called the Dynamic Yield Curve. And it is a simple animation, but just really shows the yield curve really well. This is what a normal yield curve looks like. And you can left click on a period. I'm looking back in May of 2021. A normal yield curve has a gentle upward slope. And the reason is because this is where banks are borrowing money basically down here at the short end. So they're borrowing from other banks or from the Fed or something like that. The long end is where they're loaning you money. When you're buying a house or buying a car, you're getting further and further out. A business loan, you're kind of going out on this term. So they're borrowing down here and lending out there, and that's how a bank, generally speaking, makes money, because of that natural upward slope to the yield curve. If you look at what's happening now, we have what's called an inverted yield curve, where the short end is longer, and that is higher than the long end. And the reason is because the Fed has pushed the short end. They control this, basically this end of the curve. This is more from free market forces and bond prices and other auctions and other things. So this inverted yield curve that you see labeled here usually is a brilliant predictor of recessionary periods, because that tells you that the economy is not functioning particularly well. When things get better, the Fed is able to lower rates. That makes the yield curve pushing back higher. And so we had some other questions about what tends to happen and how an inverted yield curve becomes uninverted. A lot of times the Fed will bring rates down when conditions are good, because they don't need to be jacking it up necessarily. And as a result, things start to go back to a normal phase. And that's when the economy is in pretty decent shape. I had a lot of questions, and I've heard a lot of debates in the industry with my peers about, does the COVID environment change that normal dynamic? I would argue no. When I hear people looking at something like an inverted yield curve, which has been such a great predictor of recessions, to tell me this time is different because of X, Y, Z, I put a lot of skepticism in my head when I hear that, because for me, this is just one of those consistent indicators. The yield curve was inverted because of what the Fed did related to COVID, and because of the big economic expansion after the COVID, sort of through the COVID area. At the end of the day, it's still an economy that grew very, very quickly in a very short period of time, very aggressively. The Fed kept rates very, very low as a result. Now that they have to raise them, the economy is slowing down, and that's why the yield curve inverts, and that's kind of where we're at right now. So I would say a recession pretty likely going into next year. That's what concerns me. One of the things about the big picture trend in stocks, next year and beyond, or how we digest and plan for this yield curve. If you want to go back to previous periods, by the way, this is a really good tool to go back and find other periods. For example, 2007, a major market top where we also had an inverted yield curve before we sort of rotated lower. And as the market goes down and as rates come down, we get to a more normal yield curve, which helps propel the economy back to the upside. Thanks so much, guys, for those great questions. I hope you appreciated the talk through some of those answers and use the StockCharts platform to help answer your own questions. We got to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I mentioned, this head and shoulders top. I think that is, sort of my base case now, given the environment that we've been in, given the deterioration in some key stocks and the weakening breadth conditions. I think charts like Alphabet break down even further would be one of the additional data points that would tell me further downside for the averages, probably more likely. But I am actively looking at what I call the alternate hypothesis. This is something a lot of my peers will do often, sort of have your main, base case. Here's what I think is going to happen, but here's another thing that could happen, and it's a helpful exercise because it forces you to think about what some other scenario could look like and how you would plan for it, right, and how you would trade around it. This could be sort of a 3-wave correction, and if it is an A, B, C correction, we're kind of there. This would measure to right about today in terms of the wave A and wave C being equal. In terms of the price deterioration, this is about what the measurement would tell you, so we're kind of right at that point. We're also testing this trend line using the lows from the last 12 months. This tells me it is a possible scenario, and if we rally through the course of this week, this scenario will seem more and more like the likely scenario. But I would tell you a break below this trend line, certainly a break below the 200-day moving average, Fibonacci support. This is a confluence of support levels not too far below current price action. We break that, I would say it is a very different feel than it is certainly more of a head and shoulders environment with further downside potential you probably want to consider. Chart number 2, we highlighted last week some of the bearish engulfing patterns on stocks like Halliburton and other energy stocks. I just wanted to show how things played out since then. A lot of times we focus a lot of our attention on the next great idea. We don't spend enough time looking at things that actually happened and think about that. One of the things that I will tell you is a short-term pattern like this is really only telling you about the next 1 to 3 bars. So I would not expect this to be the sign that Halliburton's going to go retest the August low. Other things would maybe tell you that's likely, but a bearish engulfing pattern like you see here would tell you that the trend in the short term, next 1 to 3 bars, most likely lower. That's exactly what we've seen. Up until today, we saw distribution, certainly on Thursday and Friday. Today, this pattern, oh boy, testing my knowledge, bullish piercing line is what this one is called, where you have a down day, an up day. Instead of getting above that top of there, you get above at least 50% through the first day. That's called a bullish piercing line because you pierced a 50% way through that. That's a short-term positive signal. So it suggests to me we've now had that distribution from the bearish candle pattern. Bullish candle pattern today says the next 1 to 3 bars may be more positive. Chart number 3, Warner Brothers Discovery, WBD. This is in a sector, and in a sector overall, which has been okay, but the entertainment, the media names have been struggling in a big way. I was listening to a podcast earlier today talking about the writer's strike in Hollywood and a potential, end, a light at the end of that tunnel, which hopefully we will see. But again, these names of some of the big studios have been pretty difficult and pretty challenged. WBD just breaking down through support today, down about 4% today. And again, I think this for me is a reminder of why I don't like to buy things at support. I like to buy things once they are breaking out. I would much rather buy things in an uptrend than a downtrend. A day like today, which pushes WD below a well-established support level around $11, tell me for now the downtrend is still in phase. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. As a reminder, we have our live Q&A this Wednesday at 1 p.m. Eastern, so don't miss out. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one.